Good morning, everybody, and welcome. This is Bellamy, Managing Director for Midstream Strategy at East Daley Capital. I'll be your moderator today for this fireside chat with East Daley's Top Gun analyst, Matt Lewis. We're talking about the Permian Highway Pipeline and its impact on Permian gas egress and basis, which is a sea change in our view. On today's agenda, a quick reminder of who East Daley is and what we do. Matt's going to talk through some fundamentals on PHP. We'll have Q&A both from me, fireside chat style, and from the audience. If you have questions, you can enter those in the question box in the webinar. I'll ask those anonymously on your behalf. I've been working in energy research since 2004. For my money, Matt Lewis is the best pipeline analyst in the world. If you are an East Daley client, and everybody on this webinar is, then you're probably aware of his expertise. Some housekeeping. We will have a recording, so if any of your colleagues may appreciate the webinar but weren't able to attend, they can watch that. We will have Q&A at the end. Again, you can enter those questions in the box on the screen, or you can email me at ebellamy@eastdaily.com. We will have another client webinar on our marquee annual report called Dirty Little Secrets on February 4th. Lastly, a portion of our research, including our estimates, is now live on Bloomberg for our customers. On top of our industry research, we have 26 of the top midstream companies modeled from the asset level. Enter ANR on Bloomberg for our coverage, and you can email sales@eastdaily.com to get set up with access. So a reminder about East Daley's process. If you're a client, you know our surveillance and methodology are the market-leading tools for midstream fundamentals. As of today, we scraped 45,362 pipeline receipt points in the U.S., and then we scour that database to map the top 2,302 pipeline receipt points, which gives us near real-time sensing of U.S. gas volumes. Our analysts then use the fundamental understanding of that data to populate our asset models, either directly or with a volumetric proxy. We have 1,150 discrete North American midstream assets modeled from the ground up. On top of that, we integrate all of the available FERC and state filings data to get contract roll-offs, et cetera. The combination of these elements gives us a superior mosaic for midstream securities research, not just on the top 26 companies whose equities we model, but also on private entities with tradable debt. Our consulting team can customize those models for you to value that. We have some services that we think no one else can offer, and we think we have a superlative engine for understanding the midstream. And that's valuable not just for midstream investors and stakeholders, but obviously if you drill something and you can't move it, then you don't have a business. So if you want to understand U.S. hydrocarbons, come through East Daley and we can help you understand the way. So with the commercial out of the way, I'm going to turn things over to Matt to talk PHP and Permian gas. All yours, Matt.
Thanks, Ethan. I think this call is set up for an hour. I know I'm very long-winded on some of these slides. Historically, I've been long-winded, but I would be surprised if we went the whole hour. So I think there'll be time for questions. So if anyone wants to ask questions, feel free to ask those in the chat. I think you're able to do that. And Ethan will jump in with questions from the audience, and I think he has some of his own as well. Just to kick us off, listen, I think most people understand the basics of the Permian Highway project, 2.1 BCF a day, going from Waha to the Katy area. Just point out some of the nuances of the project, and listen, it was a pretty clever project by Kinder to win the deal and get the commitments on their side. We viewed the way they did that was that JV partners are a big piece of that. Getting JV partners on board to commit to the pipeline and then giving them partial ownership is kind of the way that a lot of these projects have been FID'd. And also utilizing their downstream intrastate network was an important piece of this too. So looking at this map, you can see Gulf Coast Express is the blue line here. That was the first pipeline that they did. And then Permian Highway is the green pipeline. What you also see is Kinder Morgan's intrastate network as some of the other colored lines, and those are labeled at the bottom there. So what's interesting about this pipe is really when the map came out years ago, a couple years ago, of where they were going to build it, what was interesting is they're tying it into their Houston Central plant. So that's where the green line ends here is Kinder Morgan's Houston Central plant, which processes a lot of Eagle Ford gas for the company. And even before PHP was designed, they had envisioned, and I believe it FID'd what they call the crossover project, which went where that green line ends. The crossover project actually goes straight south and ties into some of that blue network there, which is their Tejas pipeline, and that in turn interconnected into some of the LNG facilities. So I imagined that the reason for that was to move a lot of Eagle Ford gas. They probably expected a lot of Eagle Ford gas production increases when they FID'd that project years ago, and the Eagle Ford slowed down quite a bit. They probably had excess space on that first crossover project straight south out of that Houston Central plant. So given that, they were able to actually probably build a shorter pipeline than some of the other competing pipelines were probably planning on doing, and just tie that into Houston Central and take advantage of some of their downstream intrastate capacity to get the molecules to market. They also did a second crossover project, which further expanded the downstream capacity and did some debottlenecking projects downstream on their intrastate lines. So what's important to note, again, it was a clever project because the greenfield piece of the pipeline is probably a little bit shorter. As you can see, it's further north than like GCX, Gulf Coast Express, because you have to make sure you're getting the gas to different markets that can handle it. I know Whistler's dumping into Agua Dulce now, but Kinder may have been a little bit wary or a little bit worried about dumping 4 BCF if they were to tie another project in down there. So a few other things here. PHP does take out leased capacity on downstream pipelines here. So in their filing with the FERC for intrastate service that connects into interstate pipelines, that's the 311 application that they have to file with the FERC, they did disclose there's about $26 million a year in lease capacity fees to downstream pipelines. So Permian Highway's paying Kinder in some cases, and a third-party affiliate. It's probably Enterprise. I don't know for sure who it is. But combined, there's $26 million in costs that PHP is paying to downstream pipelines to get some of that gas to some of these markets. So as you can see, this gas will go to Agua Dulce. It'll go to some of the LNG facilities along the Gulf Coast, and then into the Houston area and Katy area as well. So the anatomy of these projects is, I think everybody in their head thinks, oh, they're just dumping the gas into the Gulf Coast. The reason Kinder won this project was because of their downstream network, and that's probably the plan for the third pipeline that they have planned, and not FID'd yet, but they would be the ones that we would say probably has the advantage there, just because of how far along they say they are with JV customers and their intrastate network as well. Really quick, let's go. I'm going to take this back one more. Permian Pass is the third pipeline, and I don't think there's a map out for that yet, but I would imagine that going across central Texas, and then tying into some of, if you see on the right side of this picture, they do have an intrastate network on the right side here. They have NGPL, which I don't believe is listed on here. It's not. So they're 50% interest in NGPL, where they could tie that a third pipe into those networks and get the gas to different markets, including potentially Louisiana for NGPL. So I think that's the plan with the third pipe. They have said it's going to kind of the East Texas area, that Permian Pass pipeline, and we'll talk about when that pipeline may be needed later in the deck here.
And Matt, do they need to reroute that around any sensitive geography, because they did get some pushback from residents on PHP?
Yeah, it's a good question. I'm going to say I don't know, but you can see how close PHP goes to Austin and it goes through hill country. I don't think there's anything sensitive through, like, just imagine that this pipeline is going to be built right across the center of Texas. I don't know for sure. I haven't looked at it for sure, but I don't think there's too many major metropolitan areas across that route, and I would guess that they wouldn't have the type of troubles that they had with PHP.
Yeah, probably one of the few places in the U.S. where you could route a pipeline without encountering major resident pushback, which they'll still get some from somebody, but shouldn't be destructive to the optionality on that project, right?
Agree. Yep.
Okay.
So I mentioned the FERC filing earlier, the 311 filing that they have to make to have an intrastate pipeline that dumps gas into interstate pipelines. That filing is nice. It discloses some information, including some shipper information, not a significant amount of shipper information, but we do know from that filing there's 7 committed shippers on the pipeline. We know from past Kinder Morgan press releases on the project that Apache, Eagle Claw, and Exxon are all partners, and they all had capacity options, and those are listed in the table you see here. So given that information, we know the contracted capacity of the 7 customers. We don't know exactly who the 7 customers are, but we've made a potential customer guess. So Altus, I think it was in last year's 10K, it might have been the year before, but they disclosed that Apache had 500,000 MCF a day committed to the project. Now, there is no shipper on the 311 filing with FERC listed with 500 MMCF a day. So we're surmising that potentially some of that was offloaded, and Apache has 433 now, and customer 7 may have taken some from Apache. That's our guess. We're guessing Eagle Claw has 400 MMCF a day, and Exxon has 400 MMCF a day. They did have capacity options for 500 and 450 respectively. And then there's 4 other customers. I don't know who those are. And with GCX, some of the Permian producers actually disclosed that they were on the pipeline, and I think Matador was one that disclosed publicly that they had a commitment to the pipeline. I've not seen anyone else. So it may be out there. I haven't seen it. I don't think anybody at East Daley's seen it. It may be out there in a presentation somewhere that somebody says that they have committed capacity on PHP. I don't know who the other 4 customers are. I would guess that Kinder's marketing arm is a customer, and the way they typically structure that is they structure it to where they're giving, they probably are contracting out with several of the smaller producers or marketers and offer them a Gulf Coast minus price for that gas. So it essentially is like a fee-based contract for Kinder, and Kinder's not exposed to that spread at all. But I believe they did that on GCX. They did take out some capacity in a Gulf Coast minus price is what they're offering the shippers, and then they are the actual shipper on the pipeline. But yeah, that filing was a good filing for with the FERC for some of the information like this. So interesting to see, and I think the market largely expected this, but it is quite the difference in where you saw basis go because of this project. And certainly Whistler is a part of this, which is another pipeline that's forecasted or expected to come online in the second half of 2021. But what those projects did, along with the slowdown in drilling from the pandemic, is really crushed basis going forward. So you look historically, the blue bars is what the discount. So the discount is shown as positive here. But the discount that Waha had to Henry Hub in the past. So you can see you were dealing with an average between 2019 and November 2020, up to November 2020, you were dealing with an average basis discount of $1.37. And some of those times where you saw $0 or negative gas prices in some instances, which for shut-ins, obviously that's not great for E&Ps or midstream guys when people have to shut in. And then going forward, what you see is the average 2021, really November. I included November of 2020 onward in this 33-cent calculation. It's 33 cents. So you've brought down basis considerably because of these projects. There's some interesting things. You see the spread widen a little bit, and it is a little bit seasonal. We'll go over on the next couple slides why we think that maybe, for those of you guys that trade basis and things like that, this is probably a little bit too wide in 2021 and 2022. And we'll show why we think that is. But, I mean, at the end of the day, the story here, and we'll get into it, we'll get into some of the impacts, is you've debottlenecked the basin now. The basin's now free to grow, and that's going to help the midstream in certain ways, and it'll hurt the midstream in certain ways. So the guys that were the Energy Transfers of the world, the Enterprises of the world, they had marketing capacity on some of their own pipelines, and they were taking advantage of these wide spreads. And then going forward, those wide spreads are going to be gone, but there's some offsetting upsides for them as well. So mitigating factors there, and we'll go over that. Ethan, anything? I know you like this slide.
Yeah.
Anything else you wanted to talk about on this one?
Yeah, I love this slide. So how would we be, conceptually wrong here? Is there anything other than, say, some crazy scenario where we get $70 oil and associated gas production goes up and you pull forward the point where you need more capacity? I mean, is there anything other than that would make us directionally wrong here?
Yeah, so, I mean, it's unlikely. I really can't think of anything. Certainly you could have a pipeline outage that maybe affects something at some point. Whistler doesn't come online on time or has issues for some reason. But that's going to affect things probably later, like the 2023 timeframe. And we'll get into that. I think the next slide illustrates kind of where the supply is versus the pipeline capacity pretty well, and you can kind of see, hey, there's a pretty big gap between after Whistler comes online, a pretty big gap between our Permian egress supply and the amount of egress capacity that we have. So no, I mean, there's always something, right? So $70 oil comes, $80 oil comes. Certainly, you would fill the egress faster under those scenarios. A pipeline gets shut down, Whistler doesn't get put online in time or has severe delays. That could impact things. But no, I mean, it seems pretty obvious that you're going to be dealing with a much narrower basis going forward than what you did historically.
Good stuff. Let's keep going.
Yeah, so the next slide is as I mentioned, I think this details it pretty well. So let's explain the red line first. So the red line is all pipe effective. Effective is an important word here. Effective pipeline capacity out of Waha. So that includes eastbound, which are Transwestern, El Paso pipelines going to like the Arizona, California area. Northbound pipelines, that's NNG, NGPL. There's some smaller pipelines that also run northward. And then all the eastbound pipelines. It also includes the Mexico pipelines. So why we have to make this effective, in quotation marks, line is the Mexico pipelines have a much larger nameplate capacity than what they can actually carry because of lack of demand downstream. So what we do is, if you guys are looking historically at the red line, that's set to whatever the Mexico pipelines actually flowed out of Waha, so what they flowed across the border. Going forward, we do increase that about 200 MMCF a day a year. So you can see out past Whistler, if you look and squint really closely, you should notice that red line actually moves up a little bit and crawls upward slightly over time. That's our assumption that Mexico takes a little bit more gas over time. So that effective pipeline capacity does move up slightly even after Whistler. So as you can see, there's a huge gap there, huge gap between the supply and the effective pipeline capacity, but the gap fills. So we talked about this in Dirty Little Secrets. One of the main calls is, hey, these two pipelines, Whistler and PHP, are going to debottleneck the basin. Even with the reduced rig count that we've seen in the Permian, we still believe, and our commodity analysts still forecast pretty significant growth of about right around 10% a year in gas volumes. So you are going to grow into this capacity, and you are going to need another pipeline sometime in 2025, according to this. I would note that this forecast was made based on early January prices, and we're higher than that today. So this was made with just below $50, the $50 curve. and we're, at least in the near term, we're higher than that now at about $53. So if we were to rerun this now, I suspect in 2024 we'd be hitting that red line, which means, hey, Kinder with Permian Pass or another midstream company needs to make a pipeline here. So that's important to know. Yeah, go ahead.
Matt, let me press you on a couple probability estimates. So probability of a third pipe, that number, probability that Kinder does it, and a date when you think when someone or Kinder might FID a project.
So probability of a third pipe, I always tell people, like, these markets are cyclical, right? And if people want like 10-year, everybody wants 10-year production forecasts, and East Daley's happy to provide those, but they're going to be wrong, right? Because it's a cyclical market, and things like pandemics happen, which cause things to change. So at some point, I do think you'll need a third pipe. I mean, based on the current forward curve, that's going to be in 2024, 2025 timeframe, but things change, right? So I struggle to make a probability. I'm going to punt making a probability on this. I would say based on the forward curve, I'll do it this way. I'll escape the question by saying this. Based on the forward curve, I think there's a 70% probability that you'll need another pipe by 2025. Probability that Kinder gets it. Listen, I think Kinder's in pretty good shape with it. I don't think that they BS about a lot of stuff, to be honest with you. As far as how close they were pre-pandemic to getting an FID on a third pipeline, I think they were probably pretty close. They were supposedly in pretty deep discussions with some JV partners. So I would put the chances of them getting the third pipe at over 50%, probably 60%. I'm just spitballing here, but then there's that. What was the last one that you wanted?
Date, timing, when you'd expect something like this to happen based on the forward curve. 2024,
2025. And then you said when does it get FID? It need to be FID 2 years beforehand. So, so 2020, late 2022 is kind of 2022 timeframe. I think you probably need to get an FID by then. But again, based on the forward curve, we'll see if oil comes down or things change. If oil comes up, it would potentially be even sooner. So.
And in terms of what you said earlier about you have to have the network effects to have the competitive advantage here. Somebody's not going to come in here and build a spec bullet line. You have to have the downstream connectivity to have the most competitive economics. So it's going to be somebody with an integrated system that gets it done, right?
Yeah, I agree. The only caveat I would say to that is, like, we've seen, and they didn't get done, so maybe there's a reason they didn't get done, but you've seen some of the LNG guys talk about bullet lines to their facility and getting their partners to sign up for those lines. There's maybe an outside possibility something like that happens, but I think most of the LNG facilities kind of punted the idea of building large-scale pipelines. So they're mostly building their own headers to connect to other projects or other pipelines, and then take out capacity on some of the midstream guys' pipelines. So that would be the only caveat I would throw in there. Yeah, it's hard to. You have to be able to get the molecule to a market, and when you're building 2 BCF a day plus pipes, it's important to have that downstream network to where you can not just dump 2 BCF a day in one market and crush that market. You need to be able to spread that around and get that to different demand points.
Good stuff.
The other thing I'd point out, and we'll talk about this on the next slide, is impact on basis. So I've included the orange line on here as well. So the orange line is just the west capacity, which is going to California and Arizona, the east capacity, which is going to like Houston-ish markets, Katy markets, so Gulf Coast markets, which are getting close to that Houston price. Most of the gas goes there. And then the Mexico markets, which, as we explained, are demand constrained, but they do usually fetch a premium price. So as long as there's demand for that gas is largely getting a premium price. So we might flip back to this slide when we look at the next slide. But with slide 10, you can see this illustrated on the map on the left-hand side there. So there's 4 corridors. You could argue there's maybe one that goes to North Texas, but for simplicity, we'll just say there's 4 corridors of gas of where that's going out of Waha. If you look at the forward prices, California is a premium market. It's a significant premium market. And you look at the average basis on the chart I have on the right there, in blue, that's the SoCal basis. So shipping your gas to that premium market, with the exception of spring, it is a discount. But if we're talking about average yearly forward prices, going to that SoCal market's a great place to push that Waha gas because it is a premium market. I don't have the forwards for Mexico on here, but as I noted earlier, it's demand pull, and that is very likely also a premium market. You see a neutral market, that's the Houston area. So neutral market, it's slightly discounted to Henry Hub. So you're getting a very slight discount to Henry Hub, and you can see that on the graph on the right here. So it's 3 cents behind in 2021, 7 cents behind in 2022. It's the orange bar is Houston Ship Channel basis. So I'm going to flip back. So if you look at the let's look at the map one more time. Going west, going to Mexico, or going east gets you a price that's pretty close to Henry Hub. So if we go back and look at our supply, our forecasted supply out of the Permian, you are below that orange line. If you're below that orange line, the price at Waha should be pretty close to whatever the lowest price is for those three markets, which is going to be Houston Ship Channel. What's interesting is you don't see Waha pricing itself that way in the forward markets. So Waha's pricing itself closer to Panhandle basis, which is that northbound, which would be a market close to where that northbound gas goes. So that's NGPL, One Oaks line that runs north, NNG runs north. Waha on the forwards is saying, hey, you should, in 2021, 2022, Waha should be priced close to Panhandle, Oklahoma basis. Our forecast doesn't show that. Anytime you're below that orange line, you should be priced near Houston Ship Channel prices. So if our supply forecast was above the orange line but below the red line, I would wholeheartedly agree Waha should be very close to Panhandle, Oklahoma basis. But that's not what we see, and that's not what we forecast. So just an interesting point. I know we have some clients that do trade the basis markets and spreads. I at least from what I see and from we look at in our supply forecast, I think that Waha is too discounted, at least in 2021 and 22. As you get out to 2023, you can see you start to get really close to eclipsing that orange line, which once that happens or you get close to doing that, you should be tied closer to Panhandle basis. But certainly in 2021, 2022, we see Waha should again, this is dependent on Whistler coming online. We think Waha should trade closer to Houston Ship Channel prices, probably a slight discount to Houston Ship Channel prices, kind of like what you see today is maybe a 5 to 10 cent discount to Houston Ship Channel. So that's interesting. I don't have any huge disagreements with out in 2024 with where Waha's pricing. As you can see, I'll flip back again. We do get close to filling up capacity, and Waha should trade close to what Panhandle's trading at a slight discount to Panhandle probably in the future. So what does this mean for gas supply growth in the U.S.? So as you can see, East Daley forecasts about 18 BCF a day of supply growth in the U.S. between the end of 20 and the end of 24. That may seem like a lot. Some of that is due to the fact that East Daley forecasts that we're actually short supply right now. So in a normalized weather market, East Daley forecast we would be several BCF a day short. So there is some supply that's needed to balance the market, and we're using storage right now. We should be bleeding off storage in a normal weather environment, and that can't go on forever. So some of that 18 BCF a day, that's not new demand growth. A chunk of that is where East Daley thinks that we're short supply today. So there's probably 3 to 4 BCF there. The rest of the growth is going to come from LNG projects that have been FID'd. We don't have any future ones put in here, but there's almost certainly going to be some future LNG projects that make FID that have already been approved. They just need the customer commitments. But you see what this looks like. Where does this gas supply come from? So in Dirty Little Secrets, we talked about, hey, we're at 40. Back when we wrote that, we were at $40 oil. You're not going to get a lot of associated gas growth. even at this curve, and this curve was run at about $48 oil prices, so what we saw closer to the beginning of January, you get some more associated gas growth, but still the vast majority of the gas supply is going to be coming from natural gas basin growth. But you see the Permian is a big piece of this too. So the Permian does grow quite a bit, close to 5 BCF of the supply growth between end of 20 and end of 24 comes from the Permian. So as we mentioned earlier, this is, and this was also touched on in Dirty Little Secrets, and we'll touch on it in a future slide, is all of this supply growth feeds into a lot of midstream assets. So it's a big deal for the G&P, for the gathering and processing. It's a big deal for the downstream NGL pipelines, the fracs, and then the export facilities as well. Despite the fact that rigs have come down significantly, we still have pretty modest growth, or pretty decent growth for the Permian into the future. So it's not the 20% growth, 25% growth that we had pre-pandemic, but it's about 10% growth in the Permian over this forecast period each year for where we see production going. Ethan, anything else on this one that I may have missed?
Yeah, so just to underline this, if you're thinking about natural gas macro, the old fear that associated gas growth out of the Permian Basin would overwhelm U.S. gas and keep prices suppressed, that's no longer in play, even with unconstrained pipeline access to the Permian.
Not at a $48 curve, and likely not at a $53 curve, but think about this as like, as oil prices go up, you'll see the red and the blue chunks take more of the gold chunks away. So if I were to run this at the $53 curve, and we will run this in the next week at whatever the curve is at the beginning of February, the blue and the red chunks will steal gas supply from the gold chunks. So it's a push-pull type of thing based on the price of oil. But yeah, we still need natural gas from the natural gas supply basins. If we ran this similar graph pre-pandemic, most of this would be associated gas, right? So that's the way I look at it. Is this is going to be a fluid chart based on the price of oil and what the forward curve looks like.
And the winners in that gold region are the Marcellus, Utica, up to the point of constrained egress capacity, which may be even more important if MVP doesn't get done, and then the Haynesville specifically. Is that accurate?
Yep, that's accurate. You could maybe make an argument that there's slight, I mean, we'll use winners in quotation marks, but you might see slowdowns and declines in some of the other basins, some of the tier 2 basins or tier 3 basins. The Barnett always has some rigs drilling in it, surprisingly. So maybe they slow down their declines. The Western Rockies could potentially slow down their declines, although we have seen natural gas prices bump up a little bit, and not a lot of action out there as far as rig activity, despite natural gas prices rebounding a little bit lately. But yeah, it's going to be, Marcellus, Utica, to the point of pipeline egress constraints, and then the Haynesville. So, the Haynesville's extremely well positioned at this point, from our point of view, to have a lot of supply growth because of where its geography is. It doesn't have egress constraints, and even if it does, they'll be short term, because you can always just build a pipe through Louisiana or Texas. Those are two of the states that you shouldn't have significant problems building pipe through. But yeah, that's perfect. The way you said it is Marcellus, Utica, Haynesville.
Got it. And one point of clarification from a client question, and just a reminder, if you do have a question, enter it into the box in the webinar. This is lower 48 natural gas production growth in total, or just major basins?
So we talked a little bit about in the
Matt, did
Navigator.
you hear my question, Matt?
No, I did. Oh, did you add, was that a question? A point of clarification? Okay, yeah. So it is lower 48. Yeah, it's just lower 48.
Got it.
Yep.
Got it.
So looking at vented and flared volumes, so a section in the Navigator talked about, hey, gas prices aren't horrible anymore. You potentially have less flaring or less vented volumes. Certainly that's something that is going to occur as well. I don't think it's a huge upside for any one midstream guy in particular, but it probably adds a little bit of throughput through the G&P systems, and then you get the associated NGL throughput for a broad array of the midstream guys. So I don't think that there's enough flaring reduction. There's certainly a lot looking at a basin level, but that's going to be spread amongst all the midstream guys the way we look at it. So good data here from the EIA. This is Texas and New Mexico flared and vented volumes. Some of this is Eagle Ford, but a lot of this, probably the majority of this, is the Permian. So if you look pre-2018, there aren't natural gas pipeline constraints in the Eagle Ford. So when the pipeline constraints happened in the Permian, you did see flaring jump up dramatically. Most of this increase in flaring, I would guess, is from the Permian. So I would assume probably 75%, 80% of these flared and vented volumes that you see in 2018, 2019 are from the Permian. And those numbers almost certainly have come down because GCX has come online, which helped things a little bit. But now with Permian Highway and Whistler coming online, you don't have those horrible prices anymore to where it just makes sense to flare the gas. And it probably makes sense to capture a lot of that gas. You'll still have some flaring just because of not being connected into certain gathering systems, things like that. But this has likely already brought down flaring significantly. So you may see these G&P systems probably got a nice tailwind from that in Q4, starting in November when PHP really took pressure off basis prices. But a big chunk of this is good. I would imagine this comes back down to kind of 2017 levels. So if you look at the change there, maybe half a BCF of flared and vented volumes come back to the G&P systems now that we have egress and prices aren't so bad. So it's a nice tailwind. It's a nice little upside for pretty much all the G&P systems in the basin.
So I'm going to co-opt marketing terminology and call both PHP and Whistler ESG projects since they help reduce flaring and venting.
So next slide, the navigator talked about, hey, what are the impacts of this from PHP and Whistler in the future? So really, there's three impacts that we highlighted. I think the most obvious one is you have the guys that own the project, PHP, that are getting fee-based transport upside. So that's included in here. So you see Altus, $85 million in fee-based upside, and this is EBITDA. So $85 million in EBITDA upside for both Kinder Morgan and Altus. They own roughly the same percentage of the project. We also included Energy Transfer's fee-based upside. So we make assumptions because the company has said so, that they've termed out some of the capacity that their marketing arm previously held. So probably a good time to jump into that bucket. And we talked about it earlier, the midstream guys that have marketing arms and were taking advantage of the the really discounted basis were making money. They were buying the gas at discounted at Waha and using their own capacity on their own pipelines to transport that across the state and sell it at higher prices. So Energy Transfer was one of the biggest ones to do that, and it was very beneficial for them when basis was really discounted. But with basis recovering, there's downside to that marketing business. So we estimate $144 million of downside from that marketing because of the basis coming back. That is mitigated though by the fee-based upside that they see. So they've taken some of that capacity. They stated they've taken some of that capacity that their marketing arm held and termed that out with third parties. So third parties are now paying for that transport capacity across Texas. I thought they timed it really well. We don't know exactly how much they termed out. We assume almost all of it in our models, but they really did time that really well with at the end of 2020, early 21 is when they said that capacity was released from their marketing arm and went over to third parties. So those are mitigating factors. I would also point out DCP and Enterprise, also pretty decent sized marketers. DCP's pipeline, I believe, is Guadalupe. they market across that, so they'll see some downside on that. And Enterprise's network, Enterprise probably has the second most marketing capacity next to Energy Transfer. We assume no fee-based upside from them terming out fees, terming out that capacity. They very well could have. So I haven't heard DCP or Enterprise say that they've termed out that capacity, but they could see the downside in marketing mitigated just like Energy Transfer does. But we didn't model that in just because they haven't specifically said it. But it may be safe to assume that they did term out some of that capacity, and that would mitigate their marketing downside. The other upside is percent of proceeds contracts. So you do some of these G&P systems, especially with legacy contracts, are not fee-based; they're percent of proceeds based. So the gatherer or processor gets a cut of the molecules going through their processing plant. So some of that's going to be gas, right? So some of the natural gas Targa gets to receive because of their role in processing it. And then they were previously selling that in basin is the assumption. So the fact that prices have increased in basin because the egress has been debottlenecked provides upside as far as percent of proceeds contracts. So, I mean, listen, look at the EBITDA impact on the right-hand side there. Nothing really massive, I would say, for anybody. I mean, it's pretty obvious that Kinder and Altus are gonna see some upside because of the fact that they own the pipeline. But there is some downside here. So to the extent that Enterprise, we don't know, it's probably a little bit less than $85 million of downside. They probably termed out some of that capacity. But there's some winners and losers here from the debottlenecking. If we just look at fee-based marketing and POP contracts, on the next slide we'll talk about why this is good for anybody with G&P overall for their growth profile going forward.
And just a reminder, we're close to the end here. If you have questions, enter them into the box under the webinar. So last page, the graph on the left should look similar to what our supply, our egress supply graph looks like. This is the gross gas, though, so the numbers will be a little bit inflated because of the NGLs are included in here. But you can see our forecast for volumes, production volumes of gross gas in the Permian. And again, this is at a curve that's a little bit lower than where we are today. So if we were to rerun these bars would probably be a little bit higher. So the story here is you finally get a debottlenecked Permian where you can actually grow freely and not worry about having to shut in volumes or things like that. So the volumetric upside for the midstream guys is something we touched on in Dirty Little Secrets, and it's really important here because these guys have overbuilt, in many cases, their G&P networks and their G&P infrastructure. So on the table on the right here, and we had something similar in MGO, I think we included it in Dirty Little Secrets too, is our estimate, and some of this is just hard data from the Railroad Commission because we do have processing plant volumes or reported plant volumes from the midstream companies. So you can see this is our 4Q estimated throughput. So it is an estimated number, but it's close to what we have in 3Q. And then the capacity of what their processing capacity is. So if you look to the right side of the table, green is good. Green means you have a lot of latent capacity on your G&P system that's already built out or in the process of being built out. And we also included two columns that show, hey, is this G&P system in the core of the Permian? And also, is there downstream NGL upside? So a lot of these guys, let's start with the core footprint piece of the equation. Some of these G&P systems aren't in the core. So I would say Altus is not in the core. So to the extent that Altus wants to see upside from the Permian and these egress, they need to find a way to tie more volumes into that system, either by some sort of a gathering extension or having Apache or somebody else come back in and drill Alpine High. So that's not in a core area. DCP, a big piece of their G&P network is not, and G&P infrastructure is not in the core of the Permian. So despite the fact that you see this graph moving up and to the right, they're probably not going to see the kind of growth that some of the other systems are. And I would say the same for Summit and Rattler as well. Most of the other systems are in areas where we would say are core areas and are going to be active, have active drillers on them.
NGL upside column just highlights, hey, do these guys have NGL pipelines that these higher processing volumes and NGL volumes are going to feed into, and really lever them to more and more upside tied to higher and higher volumes. So Energy Transfer has a huge network. There's a lot of capacity on their NGL pipelines out of the Permian. I think the fracs largely are under MVCs across the board. So probably not a lot of frac upside for these guys, but the NGL transport upside and then potential export upside at some of these facilities. Exports at Energy Transfer. I think Targa has an export facility, and then Enterprise as well. So look at the last three columns. If you're all green across the board, you have a decent chunk of kind of low capital intensive upside from these growing volumes in the Permian. So Energy Transfer and Targa are perfect examples where they can fill that latent capacity. They're in the core and they have NGL upside downstream. So that's I think is what the most important impact is from this is the upside in the future from, hey, we're free to grow, and then you get all the upside from the G&P volumes and then the downstream NGL volumes as well.
And I should also point out here, Matt, that we've got the public securities listed here on this table, but for you private equity guys, we also have, you know, the big private equity players like Lucid modeled. So we can be useful to you there if you're interested in thinking about how that may play into Permian midstream consolidation, as well as looking at the debt around some of these private entities.
So that's all I had. Ethan, are there other questions or summary that you want to run through?
Yeah, I will, let's just take it from the top, which is, the clear beneficiaries here are the E&Ps on better netbacks, and that window remains open for probably a good 2 to 3 years, depending on how fast and how and if oil prices rise. So if you're thinking about marginal wells that have gas economics included and oil's not just the driver anymore, that's helpful. The second is that certainly this is going to take and has already taken flaring down. So for those companies that, have made commitments on flaring, the excess capacity certainly made that easier and made the economics of some of those connects a lot better than it was in the past when we had a $1.30 diff versus the 30 cents we expect going forward, which may be even lower than that. The losses aren't huge, and then the one standout clearly on a size basis is Altus Midstream is a winner on the amount of EBITDA relative to the size of the company. So in terms of the public securities, that's there are some other issues at Altus obviously, but in terms of the biggest driver outsized impact on any specific company, it's clearly Altus. And then just overall look for our next update to likely pull forward the inflection point where new capacity is needed, as Matt has been pretty clear about. So we did get one question from the audience, and again, we'll wrap this up pretty quick unless I see some more. Is Matt including Targa's future Helm plant coming online in the fourth quarter of 21 in terms of latent capacity? And I'm not sure about that question, and I don't know if that's stack.
So we can follow up, but I'm pretty sure I told the analyst to include, if something's under construction, to include that in the capacity line. So that would be included in latent capacity. So I'm pretty sure that's included in Targa's number, yes.
Yeah, and overall, we're pretty constructive. I mean, if you look at where the rigs are, and we allocate every rig to every G&P system out there. The biggest rig allocation system-wise are West Texas Gas, which is a private entity, family held, and at Targa, and right now at Lucid. And Matt, I have one theory I want to run by you, which we haven't talked about before, which is that we've had all this federal lands leasing issue, and my suspicion, based on the way the rigs have been allocated in the short term, particularly in New Mexico, is that we might actually see a surge in federal lands production in the next 18 months because of fear that longer term you won't be able to develop those assets. So that takes a priority before we see a decline. What do you think about that? And then we have one more question after that, and we'll wrap it up.
Yeah, I'm not the expert on the federal lands piece, but I have no reason to disagree with you on that. I think that makes sense, that could possibly happen.
Okay. Last question. Where will Whistler source its volumes?
So I think it's tied directly into to Waha. I will actually have to look at a map and see, but it's certainly going to have capacity into some of MPLX's plants. I think Whitewater's a partner on that project as well. I think, correct me if I'm wrong, Ethan.
Yes.
I think WTG might be a partner on that as well. So they can either directly tie into their plants or have upstream capacity on other pipelines that tie into to the receipt point of Whistler. But yeah, I think Whistler, I mean, I would imagine it's tied into Waha, so it's able to pull from Waha and potentially other plant connections as well. I don't know that for sure, though. I would need to look at the map to see that for sure.
Yeah, pretty interesting to see MPLX benefiting from supply growth in both the Marcellus Utica and the associated gas growth in the Permian. It's like I'd say we're pretty constructive on Whistler in terms of the network effect for MPLX.
Yeah, and I'll digress a little.
Yeah.
Sorry, I was just going to digress a little bit on MPLX. Their Permian system's a little bit forgotten, I think. They do have 6 to 7 rigs on that system that are drilling, so we are pretty constructive with our G&P outlook for MPLX's system in general. And they are guys that now are doing the downstream stuff, so they own a piece or have an interest in EPIC, which is kind of their own interest, where they can enjoy some of the upsides from some of those downstream NGL stuff. And I think I don't know the exact financial terms that they came to an agreement with EPIC to get that piece of EPIC, but I would imagine they got a pretty good deal based on the overcapacity that we see for NGL pipelines. So yeah, I think we're pretty constructive on MPLX as well out of the Permian.
Thank you very much, Matt. Excellent presentation. Thanks, everyone, for joining us. A reminder, we have a webinar on our overall marquee annual report, Dirty Little Secrets, on February 4th. Our estimates are live on Bloomberg. sales@eastdaily.com if you want to get involved. Bellamy@eastdaily.com if you have follow-up questions. With that, we will wrap it up. Thank you for your time, and tell your colleagues we have a replay available if they need it. Thanks, Matt.